Frequently asked questions and gray areas in Arizona transactions. By the time a rule reaches daily practice, agents are no longer asking theoretical questions. They are asking practical ones. Investors want clarity. Escrow wants predictability. Brokers want consistency. Section 6.2 addresses the most common questions Arizona professionals will encounter and explains how to navigate gray areas without crossing into legal advice. FAQ number 1. Does this apply to commercial property? The 2026 FinCEN rule primarily targets certain residential real estate transactions. Large commercial office buildings, industrial warehouses, and retail shopping centers are generally outside the primary residential scope of this rule. However, 1 to 4 unit residential properties are included even if used strictly as rentals. For example, a duplex in Tucson purchased by an LLC with cash may trigger reporting. A fourplex in Mesa purchased through a newly formed entity with private capital may also fall within scope. In contrast, a 50,000 square foot industrial warehouse in Phoenix, purchased by a corporation, would likely fall outside this residential-focused framework. Agents working in mixed-use markets must carefully distinguish property classification. The question is not how the property is used. The question is whether it qualifies as covered residential real property under federal definitions. FAQ number 2. What about refinance transactions? Refinances are generally not acquisitions. The rule focuses on purchases of residential property. A refinance of an existing mortgage through a federally regulated lender does not typically trigger a real estate report under this transaction-based framework. However, if ownership structure changes simultaneously with refinancing, the situation becomes more complex. For example, if a property is refinanced while simultaneously transferring title from an individual to an LLC, that ownership transfer component may require further analysis. In such scenarios, agents should coordinate with escrow and encourage clients to seek legal guidance. The key distinction is this: refinancing alone does not equal acquisition. Ownership change may. FAQ number 3. What about transfers between related LLCs? Arizona investors frequently move properties between LLCs for liability segmentation, estate planning, or portfolio management. If a residential property is transferred from one LLC to another without institutional financing, reporting may still apply if the transfer qualifies as a covered acquisition event under federal definitions. For example, if an investor transfers a Phoenix rental from Sun Valley Rentals LLC to Sun Valley Holdings LLC before closing on a sale, escrow must determine whether the transfer constitutes a reportable transaction. Agents must not provide structuring advice regarding internal entity transfers. The safest response remains procedural. Coordinate with escrow and refer clients to legal counsel for ownership restructuring decisions. FAQ 4. Does this apply to probate sales? Probate status alone does not trigger reporting. The rule focuses on the buyer's structure and financing method, not the seller's probate classification. For example, if an estate sells a residential property to an individual buyer using conventional financing, reporting likely does not apply. If the estate sells to an LLC using cash or private capital, the reporting framework may apply depending on trigger elements. The controlling factors remain entity status and financing type, not probate process. FAQ number 5. What about trust purchases? Trust structures require careful analysis. A revocable living trust used for personal estate planning may be treated differently than a business trust formed for investment holding. If a trust acquires residential property without institutional financing, escrow will evaluate whether beneficial ownership disclosure is required. For example, if a married couple purchases a Scottsdale home in their revocable living trust with conventional bank financing, reporting may not apply. If an investment trust purchases multiple rental properties using private funds, reporting may be evaluated differently. Agents should avoid interpreting trust law. When trust structures arise, refer legal questions to counsel and coordinate with escrow for reporting determination. FAQ MER 6. Does this apply to 1031 exchanges? A 1031 exchange under Internal Revenue Code, paragraph 1031 allows tax deferral on qualifying property exchanges. It does not override federal transparency requirements. If the replacement property is residential, acquired by a legal entity, and financed without institutional lending, reporting may still apply. For example, an investor selling a Mesa rental and acquiring a Chandler duplex through an LLC using exchange proceeds and private funds may fall within reporting scope. Tax structure and transparency reporting operate independently. FAQ number 7. What if the buyer is a U.S. citizen? Citizenship does not control reporting triggers. The rule focuses on entity ownership and financing structure, not nationality. Even U.S. citizens purchasing through LLCs without institutional financing may trigger reporting. This distinction is important because agents often confuse this framework with FIRPTA compliance under 26 U.S.C. paragraph 1445, which applies to foreign sellers. The two regulatory systems are separate. Transparency reporting concerns structure and financing. FIRPTA concerns foreign ownership taxation. FAQ number 8. Can the buyer take title in their personal name to avoid reporting? If an individual purchases residential property in their personal name using cash, the entity-based trigger may not apply. However, agents must not recommend structuring changes for the purpose of avoiding federal reporting. That decision involves legal, tax, and asset protection considerations beyond the scope of real estate licensure. Providing advice intended to avoid federal reporting could create exposure under ARS paragraph 32-2153 for dishonest dealings or substantial misrepresentation. The appropriate response remains consistent. Refer structuring decisions to the client's attorney. Professional neutrality protects your license. FAQ number 9. What if ownership percentages change before closing? If ownership percentages are modified shortly before closing, and the transaction otherwise meets trigger criteria, reporting may still apply. Escrow will evaluate beneficial ownership at the time of closing. Simply reallocating percentages to fall below 25% ownership thresholds does not necessarily eliminate reporting if substantial control remains present. Agents must not advise on ownership percentage adjustments. If a client suggests percentage manipulation to avoid reporting, the safest response is procedural. Reporting requirements are determined by federal law and escrow evaluation. FAQ 10. Is this public information? No. The real estate report is submitted to FinCEN. It is not recorded with the county recorder. It is not published in the MLS. It is not publicly searchable like deed records. This clarification often reduces client anxiety. The report is federal financial reporting, not a public property disclosure. Gray area principle. When uncertainty exists, apply the three-part trigger test. Covered residential property, plus legal entity buyer, plus no institutional financing. If all three are present, assume escrow will evaluate reporting applicability. When in doubt, escalate to your designated broker and coordinate with settlement professionals. Under AAC R428-1103, documented escalation supports reasonable supervision and demonstrates proactive compliance. Transition to Section 6.3. Now that we have addressed common questions and gray areas, the final section of this course will look forward. Section 6.3 will focus on adaptability, professional positioning, and how Arizona agents can remain confident as federal transparency enforcement continues to evolve.